Real estate funds, what are they? How do they work? And what are the pros and cons? That's exactly what I'm going to be walking you through in this video today. And just in case we're meeting for the first time, I'm Seth Ferguson. I'm the COO of CPI Capital. I think it's now 16 years I've been involved in real estate. So we've done a whole bunch of stuff in the multifamily space and commercial real estate. So let's dive right into it and talk about what real estate funds are, because there's a lot of interest in real estate funds. If you're looking at passive investing options, funds are a great option. If you're looking to raise large amounts of capital, funds are definitely a great option. But there's a lot of misunderstanding out there about what funds actually are, how they're deployed, how they're employed, and then the pros and cons and what structures you really should be using. So let's dive right into it and get into what real estate funds are. And like I said, they're a structure that is used to acquire real estate. Now, most of the time, you're going to be looking at acquiring a large volume of real estate using the fund model. Now, the question is, why is that? Well, the fund model allows us to acquire a number of properties all under one umbrella, so to speak. So as opposed to syndication, where we're acquiring a single property at a time, or just buying a property one by one, a fund is able to go out and have a life of its own. I'm going to get into that in a little bit. How do real estate funds actually work? Well, there's really two key components or pieces that make up a real estate fund. Okay? So on the one side, we have something called the GP, and then on the other side, we have something called an LP. Now, the LP stands for limited partnership, and these are the passive investors in the fund. So you've got your doctors, your lawyers, programmers, business owners. These are the passive investors who have capital, who have cash money that they want to invest in real estate, but they don't have the team, the track record, the time, nor the experience to do it on their own. So perfect example. Let's say there's a doctor out there. Doctors work crazy hours. They also earn large amounts of money, and they want to invest that money for their future. The doctor on their own, if he's got, let's say, 200K he wants to invest, he'd be able to buy one single family home. But we all know that single family homes aren't geared towards investing and generating large returns. So on their own, the doctor wouldn't be able to buy an apartment building. But if we're able to pool that doctor's funds with other passive investors, well, now we're able to invest in maybe a $10 million asset, 20, 50, $100 million asset, and get all the economies of scale, all the benefits, the stronger cash flow, the greater stability, the tax benefits that come along with doing that. So that's why a doctor or accountant, programmer, business owner would want to invest in a real estate fund. So like I said, the LPs, they're afforded protections under the law because of the structure that's used. So it really limits their liability in this. So for example, let's say you bought a house yourself and you want to rent it out. Well, you are 100% liable for everything that happens. And if something really bad occurs at the property, well, you could lose your initial investment in that house, but then they can come after you for a whole lot more. By using the LP structure here, with the LPs, the limited partnership, their risk is limited. Their risk is limited only to the cash they've invested. They're not liable for anything else. So the whole world could explode and something goes really, really wrong with that asset. They're only on the hook for the initial investment, which is a big advantage, especially to the wealthier investors that end up investing using these structures. It really limits their risk exposure. Okay, so the LPs are bringing capital, cash, and generally most of the time, the LP is made up of multiple investors. Now, the general partnership, the GP, these are the people who are actually running the fund manager. So who has the deal flow? Who knows where to find the deals? Who understands the markets? Who has the connections? Who has the team? Who knows how to manage these assets? Who knows how to fund the assets? Who knows when to buy them, when to sell them, how to negotiate the terms, how to pull the value levers to maximize the returns that those assets are producing? That's the GP. So that's us with CPI. That's what we do every single day. We have an entire team that does this. And actually, if you are interested in learning more about this from a passive investor standpoint, you can go to sethferguson.org/invest. You can book a call with the team and just learn, what we're doing and if it might be a good fit or not. So sethferguson.org/invest. So the GP is the one that's managing the money, managing the funds, making those executive decisions about what assets to buy, when to sell, when to refinance, what things to do. Because let's face it, if you're a business owner, if you're a programmer, if you're a high income earner, you're already busy doing what you're doing day to day with your own career. You don't have time to start a brand new business from scratch which is in the real estate business, and do that. It's far more efficient just to invest in a fund structure like this and enjoy all the protections, but also you get all the benefits of owning large scale apartment building real estate. It makes a lot of sense to do, and that's why so many people invest in companies like ours and other real estate companies out there. Okay, so that's the structure. So what happens as the fund, so let's say this is the fund right here, the umbrella, the fund will go out and it will acquire this asset here. It will acquire this asset here under the fund umbrella, acquire another asset. Now, after a couple of years, it may sell this one, may divest of these two, and acquire another 5. And really, the fund has a life of its own. It will grow, it will contract, it will grow again, depending on market conditions, what's going on with the properties in the fund itself. But the fund isn't a one-off type of thing. It will acquire assets, it will sell, it will acquire some more. And funds can last for 10 years, they can last for 5 years, they can last for 20 years, 30 years, 50 years. There's different types of funds with different time horizons for their lifespan. But that's really what a fund's doing, and it's very different from a syndication. A syndication it employs a similar structure to this, but it's just for one specific property. A fund, you're investing in the fund, and then the fund goes out and deploys that capital and does multiple deals over the lifetime of the fund. So I hope that's clear in terms of what the fund is. Now, there's always pros and cons to what happens, to how to invest your money. So pros and cons to investing in a real estate fund. Okay, so let's do pros and we'll do cons over here. Okay, so con number 1, if you're looking for control over your money, if you're looking to control everything that happens with your with the money that you've invested, a fund is not for you. Because what happens is with the GP, with the fund manager will set fund criteria. So it's basically saying, hey, these are the types of properties, these are the types of areas, this is the general business plan that we're looking to follow with the fund. That's called the fund criteria. And so with an investor, the fund manager will say, hey, Mr. and Mrs. Investor, these are the fund criteria. This is what we're looking to do. Would you like to invest in this? Right? And then the investor will make a decision based on those fund criteria. It's not like a syndication where the sponsor will say, Mr. and Mrs. Investor, I have this specific deal. Would you like to invest in this deal right here that this is what it is? No, with the fund, there's fund criteria, and that's what the investor is investing in. So if you're somebody who is looking to control everywhere their money goes and know exactly what property it's going and be able to veto some properties, the fund isn't for you, because you're essentially trusting the experience and the track record of the fund manager to make those educated expert decisions in your best interest, right? That's what happens in a fund. So if you don't want somebody making those expert decisions and you want to be able to dictate, hey, I want to invest my money in this deal, but not this one, but this one, fund is not for you. The second con, if you're looking for a quick exit, right? Because a fund is not liquid at all. So if you're looking to bring your money in and 3 months later, 6 months later, take your money out, a fund isn't probably going to be the right structure for you, because oftentimes, investors, especially with us, will invest for, 3 years, 5 years, 10 years in a fund. It's very illiquid. Now, for a lot of investors, the illiquid nature of the fund is actually an advantage, because it's like the time you spend in the market, especially in an asset like real estate, the more time you spend in the market, the more your investment will most likely grow, right? So if you have these knee-jerk reactions, there's a blip in the market, and then you're just jerking your knees and you're pulling that money out, generally it doesn't work very well. So the longer your money spends in the market, in the fund, in these cash flow producing assets, it's an advantage. So that illiquid nature, not being able to make those quick knee-jerk reactions, it actually saves a lot of investors from making poor decisions based on emotion rather than logic. But I get it. Sometimes you're looking to get your money into the market for a year, pull it out. A real estate fund is not for you in that case. It's not designed, it's not built, it's not engineered for that. If you're looking for a longer term investment, it's not get rich quick, but get rich for sure. A real estate fund is definitely for you. And then the third con is it's not accessible. So what I mean by that is there's going to be income requirements and asset requirements. So if the fund is working through the exempt market, so if they are raising money from what's called accredited investors, not everybody can participate. So an accredited investor, in a nutshell, is somebody who earns over $200,000 a year, $300K as a couple, or they have $1 million of net assets, excluding their primary residence. You can't count your house, right? If you own other properties, you definitely can. But 200K individual, 300K as a couple, or $1 million of net assets, not including your primary residence. So the fund is exclusionary. And what I mean by that is not everybody can participate. The government, it's not the fund manager, the government has set these expectations and requirements for somebody who's able to participate in real estate funds that are going the exempt, what's called the exempt market. So what you'll find is, and that's why I mentioned you have a lot of lawyers, business owners, doctors, programmers, athletes, a lot of people like that, those high income earners, they invest in a lot of these real estate funds. So it's not accessible to everybody. There are requirements, and that definitely could be a con because there are a lot of people who know a lot about real estate, but because they don't meet those income requirements, they're not able to participate in select real estate funds where the government's impose those requirements. So you want to do your research. If you're not sure, you can definitely book a call, sethferguson.org/invest, and we can actually help you walk you through this stuff and determine whether or not you're at, you qualify for these types of investments versus other types of investments. So you can book a call if you're on the fence and you're not quite sure, or if you know you're an accredited investor, book a call and then we can walk you through some options we have for you for these cash flow producing multifamily assets. Okay, so those are the three cons. No control if you're looking for that. You're not liquid. It's not a short-term thing, and there are income and asset requirements to participate. Now, there are a lot of pros when it comes to a real estate fund, a ton of pros when it comes to real estate. So pro number one, the money is ready. So the money is ready to go. So let me walk you through what generally happens with other types of structures. You find a deal. This is like syndication. You find a deal, you get it under contract, and then that person has to go off and raise the money. And they're in a very, very tight timeline. With a real estate fund, the money's sitting there. The powder is dry. There's a huge fund of money sitting there ready to be deployed. So depending on the situation of the asset, the seller, depending on the market conditions, the fund can be a huge advantage because the money's sitting there. So the seller knows that the fund has the money already. And oftentimes, if the situation's right, the fund can negotiate a discount or better terms for that deal because they're ready to rock. There's not the risk the seller has that this person has to go out and now raise $20 million in the next 60 days. And if they can't do that, the deal falls apart. There's a lot of certainty there for the seller. And there's a lot of certainty there for the fund as well, because the fund knows it has the money in the bank. So there's no hoping or being like, oh, maybe we can't raise this. The money's there. The seller knows the money's there. The deals can get done quickly, and that can unlock some advantages in terms of price and terms for doing that deal. So it can work out for the fund, but also the investors who are investing in that fund. Now, the second pro is diversification. Now, obviously, that's a long word to write live as I'm talking. So diversification. So with the syndication, like I said before, it's a one-off type of deal. So you invest in that one asset and that's it. With the fund, your capital, your money is spread across multiple properties. Maybe the fund has 5 properties. Maybe it has 10, maybe it has 50, maybe it has 100 properties in it. So your money, your funds are spread across the entire fund portfolio. Now, what does this do? In case one property underperforms, something happens with it, there's still all the other properties in that fund to boost it up, to shore it up, so all of your eggs aren't in one basket. Now, going back to control over here, some investors, they want to dictate, yes, I want to invest here, I want to invest here, I don't want to invest in this deal. So in that case, syndication is great because the investor can make the call. But if you're looking to invest your money with a trusted, a proven fund manager who they have the track record, they have the experience, they have everything you're looking for, and you want them to go out and acquire these assets and take advantage of that diversification and spreading your funds across multiple properties, the real estate fund is a huge plus for you because that's exactly what it's designed to do. Now, the third pro is your money keeps working. So let me do like a fist with a bicep, right? That's the muscles right there. It keeps working. The money keeps working. So what happens in a syndication is you invest your funds in the syndication, and then at some point, maybe after 5 years, the deal's going to sell. Now you have this big fat check, and now you have to go out and find another syndicated deal to invest your money in, right? That's for somebody looking for full control. That's right up your alley. But if you just want your money to keep working in the market without that downtime, a fund could be something you want to consider. And the reason is, once the fund sells one asset, well, now it's going to go out and acquire other assets, but it still owns a whole bunch of other properties. So your money keeps working and working and working. Now, eventually, if the fund is designed to wrap up in 10 years, yes, at the end of the 10 years, you're going to get the big fat check from the fund. But rather than having this happen every single deal where now you have this money, now you have to deploy it again, so it keeps working, you don't have to worry about it. It's more like a one-stop shop. You invest your funds, and you can always reinvest, but it's working. You're getting the monthly mailbox checks or the quarterly checks, depending on how it's set up. You're getting the fund reports from the fund manager, but you're not always worrying about, hey, where does my money go next? Because it goes right back into the fund and it keeps building and building and building. So it all depends on what type of investor you want to be and what's important to you. If you're looking for that full control, if you're looking for those quick exits, if you don't meet those income requirements, fund's not for you. But if you're looking for that, if you're looking for the diversification, if you want to invest in an entity where that money's ready to rock, there can be advantages there, and you don't want to worry about, hey, where your money goes every time you exit a deal, well, a fund could be a great option for you. Plus, with CPI, we've got some special investment tools for Canadians. We have Americans and Canadians invest with us. If you're a Canadian, we actually have some pretty cool things that we can do with registered funds like your TFSAs, RRSPs, RESPs, that type of thing. So book a call at sethferguson.org/invest, sethferguson.org/invest. Book a call with our team. We'll see what we can do, what works best with your current situation, figure out, build out a roadmap for your investing. And if we can help you out, great, we'll let you know. If not, we're happy to point you in the right direction. So I hope this helped running through what a fund is, how it works, and the pros and cons. Like if you're looking for multifamily real estate investing, there's no better place. Book a call, sethferguson.org/invest.